In March of 2010, the Jamaica Deposit Insurance Corporation, JDIC, staged the first Caribbean Bank Insolvency Conference at the Rose Hall Resort and Spa in Montego Bay. Over 20 experts from countries across the Caribbean, Canada, the United States and United Kingdom spoke on issues relevant to the global financial crisis, international initiatives towards best practices and resolutions for bank insolvency. Today, we feature highlights of the addresses given by Associate Professor in International Banking and Finance Law at the University of Leeds School of Law, Andrew Campbell, and Principal Economist in the Financial Affairs Division at the Organisation for Economic Cooperation and Development, OECD, Dr. Sebastian Schich. Mr. Campbell discussed the role of deposit insurance in the 2007-2009 financial crisis in the UK. Dr. Schich addressed the matter of the government as guarantor of last resort, benefits, costs and premium setting issues. Dr. Sebastian Schich is a Principal Economist in the Financial Affairs Division at the Organisation for Economic Cooperation and Development, OECD. He serves on the OECD's Financial Markets and Insurance and Private Pensions Committees.
The lender of last resort role has been very much at the center of the response of policy to this crisis. Central banks, in their role as lender of last resort, typically feature prominently in any crisis response through various tools for supplying central bank money to financial institutions, as well as to markets. Central banks have announced their willingness to lend as much as is needed, thus allaying concerns about funding liquidity. Now, effectively, what this means is that by making such promises, central banks have become guarantors of some part of banks' balance sheets. Governments have also directly targeted other parts of bank balance sheets. Now, these guarantees have helped stabilize the financial system. First of all, they have raised the likelihood that depositors continue to provide a stable source of financing. And also, they have done one other thing, which is they have provided safe investments at a time when safety was very much in demand. And they have done so at relatively limited upfront fiscal costs. Actually, as we learned from the presentation earlier on, the FDIC, for example, the FDIC has made a significant actuarial profit so far from these type of guarantees. Now, that being said, there are also potential costs associated with such guarantees. First of all, they create large contingent fiscal liabilities. Second, they are liable to introduce competitive distortions. For example, they could provide competitive distortions or distortions to competition between those instruments that benefit from guarantees or those institutions that benefit from guarantees and those that do not. But also, and that's something I will explore in a little bit more detail, ideally to limit such distortions, risk-based premiums need to be specified. However, the results in this regard have been rather mixed. They depend, though, on the specific type of guarantee that is under question. First of all, the fees for asset liability guarantees have generally been risk-based, although the details have been institution-specific, but there has been an attempt to use similar principles, at least at a domestic level. A fee was, however, charged for the introduction of new guarantees for unsecured bank bonds. But, as I will argue, the fee premium charge has not always been adequate. Now, an effort has been made in this context to harmonize fee structures, making fees dependent closely on the issuer's credit default swap history, actually. But a common fee structure is only adequate to the extent that the sovereigns have the same credit quality. The financial safety nets in many countries were expanded to include a new function, which is the guarantor of last resort function. And now, as the crisis has abated, several of the guarantee programs have expired. But it is nevertheless questionable whether the guarantor of last resort function can ever be fully withdrawn. Actually, once a government has ventured down that road of providing extensive guarantees in one specific systemic crisis, it may foster the expectation that similar guarantees will always be made available in similar situations. In short, there's a clear time consistency in a systemic crisis. Ex-ante regulators would like to commit to not providing a guarantor of last resort function so as not to encourage banks to underestimate the costs of extreme negative outcomes. However, this strategy may not be optimal ex post, and hence it may not be credible. The guarantor of last resort function may de facto have become part of the financial safety net. Some would argue that it might actually have needed that function. That is, for example, the view of some academics such as Ricardo Caballero. But be that as it may, the safety net is a combination of institutions and rules. And the traditional safety net had a certain internal logic and consistency. The new structure, however, is not yet well defined. And the de facto addition of the guarantor of last resort function raises a number of different issues. For example, where there's an overlap between different safety net functions, design aspects of also the other elements of the safety net may now need to be adjusted. And that includes, for example, deposit insurance. And first and foremost, once the government has revealed itself as a guarantor of last resort, beneficiary institutions need to pay an appropriate premium in exchange. But how that premium should be charged is not so clear. In this context, OECD's Committee on Financial Markets has agreed for the committee to conduct further work on the pricing of guarantees for the guarantor of last resort function, focusing in particular on the narrow subject of guarantees for unsecured bank bonds.
Andrew Campbell is an associate professor in international banking and finance law at the School of Law, University of Leeds in the UK. His specialist areas are bank insolvency, depositor protection and banking regulation. Mr. Campbell is also a consulting counsel to the IMF.
Basically, since 1878, we haven't had any bank runs in the UK. We've had a few problems like BCCI and so on, but they didn't lead to bank runs. It was early autumn 2007. The next run occurred and it came apparently without too much warning. This bank called Northern Rock, which had been a building society, had been growing at a ludicrously rapid rate. But this does not appear to have been something picked up by the regulators or indeed the central bank, or at least it might have been to some extent. Everything's a little bit unclear. Now, I don't want to focus today on the regulatory or central bank failures. I want to look at the role of deposit insurance in this particular crisis. This bank had been a very, very conservative organisation, lending only for house purchase, always on a fully secured basis, but in the last few years had started to grow aggressively after it had converted from being a building society to being a bank. By 2006, its business model had changed. It was taking about 75% of its money from the financial markets rather than from deposits. And it was raising a lot of its money directly in the financial markets. As I say, I'm not going into that aspect of it just now. I'm just setting some background. Profits were booming. It was growing at an exponential rate. Warning signs should have been ringing. Chief Executive Officer claimed the balance sheet as being low risk, which was clearly not the case. entered the subprime market at some stage. And when the liquidity started to dry up in the markets in August of 2007, Northern Rock was in difficulties. Went to the Bank of England for help. That was initially refused. But eventually, on the morning of the 14th of September, this announcement was going to be made. The Chancellor of the Exchequer has today authorised the Bank of England to provide a liquidity support facility to Northern Rock. The FSA judges that Northern Rock is solvent, exceeds its regulatory capital requirement, and has a good quality loan book. The important thing to realise was, although the pictures on television of showing lots of people queuing or lining up outside Northern Rock branches was what people think of as the run was really taking place online. Prior to that weekend, almost nobody knew of the existence of the Financial Services Compensation Scheme. But when they became aware of it, when finally somebody on BBC mentioned this, it got worse. Well, the Chancellor, apparently after having discussions with the Prime Minister and other relevant parties, announced that all deposits at Northern Rock would be protected, not just up to the limit of the compensation scheme, all deposits at Northern Rock. Blanket guarantee right away. Also, this protection would cover other banks during the current crisis. A blank cheque had been written for the entire deposits in the British banking system. And this was in relation to a small, relatively unimportant mortgage bank in the northeast of England. But that stopped the run. And Northern Rock has since been nationalised, as was mentioned yesterday. Now, the crucial point here was that the 100% cover was only for the first £2,000, raising the spectre of co-insurance. So a depositor with $35,000 would lose $3,300. Customers were not impressed. And that helped increase the rate at which people tried to get money out. Most of the customers involved in the run had balances well in excess of £2,000, but not in excess of £35,000. Approximately 96% of the UK bank deposits were covered by the £35,000 ceiling, especially as this was doubled to £70,000 for joint accounts. But a high percentage had more than £2,000, and they didn't want to lose 10% of anything. The UK, and I should add, the EU, has now completely removed co-insurance. There is no concept of co-insurance anymore. And 100% cover was initially increased to £35,000, as I say, double for joint account, and the EU has got rid of this. So that's, from my perspective at least, a very welcome development. It has since been increased again to 50,000, and there's a proposal to increase it again to 100,000. Further reform is under consideration, especially in relation to the speed of any payouts. The aim within the UK at the moment is to manage 1 week. So, ex-ante funding, good idea. I think ex-ante funding should be mandatory for deposit insurance schemes. Now, what about the role of the deposit insurer in the financial sector safety net? It now has an expanded role, a slightly expanded role to play in the new legislation Dalvinder was talking about yesterday, but still relatively limited. When you consider Donald talking about the kind of things the FDIC can do, our deposit insurer is not in the same league. The lesson, if there is one, there are obviously lots of different lessons to be learned during this type of crisis. But I think from a deposit insurance perspective, what we witnessed was that a poorly designed deposit insurance scheme can make the crisis worse. So it's not a case of it making it less bad or something like that, and not as good as it could have been, but actually making it worse.
In our next episode, we'll feature the presentations of Chairman of the Jamaica Deposit Insurance Corporation, the Honourable R.N.A. Henriquez, and Director Deposit Protection of Swiss Banks and Security Dealers, Patrick Loeb.